Welcome back, students. This week we study lesson number 2, chapters 3 and 4 from your textbook. I should mention here that some of you have had a little difficulty locating a textbook, but presumably everybody has one on the way now. And because we have some catching up to do, I have changed the assignments for lessons 1 and 2. The discussion question should read the last item only for each chapter, chapter 1 and 2. Therefore, will be the last item in discussion question 1 and discussion question 2. And then the same is true for chapters 3 and 4 on this section. Chapter 3 introduces the double entry accounting system. In order to accurately capture the vast number of financial transactions that a business engages in each year, a system was introduced over 500 years ago. We discussed this in class last Monday. We call this the double entry bookkeeping system. It is somewhat like the traffic laws that keep cars and people flowing in Los Angeles. Yeah, sure. Red means stop, green means go. In our analogy, this would be the debits and credits. We begin with the accounts. An account is an individual record of increases and decreases in a specific asset, liability, or stockholder equity item. We saw a list of accounts used in the balance sheet report in Chapter 2 on page 75. Note that there are 3 classes of accounts: assets, liabilities, and equities. For teaching purposes, we display these as T accounts, so called because they represent the letter T, or they resemble the letter T. In actual practice, these accounts are managed by computers and no longer take physical form until it is time to report account balances. The terms debit and credit refer to the left side and right side respectively of each T account. The fundamental accounting equation guides us when recording increases and decreases in an account using debits and credits. For example, all asset accounts, a debit represents an increase, while a credit shows a decrease in that account. Liabilities and equities are exactly the opposite, with credit entries to represent increases and debits showing decreases in these same records. Asset transactions are categorized as to source, exchange, and use transactions. The text gives several examples of each. Note that every transaction involves 2 or more accounts. One account is debited, the other is credited. We call this system double entry bookkeeping. Note also that each transaction is presented in horizontal format that emphasizes the accounting equation. This is to help you understand the effects of each type of transaction on the financial reports. The process of generating data to be entered into the accounts begins with source documents. These include sales receipts, invoices, checks, time cards, deposit tickets, and so forth. Every transaction must begin with and be backed up by a source document. These are stored until they can be legally shredded, generally for a period of 2 or more years, as dictated by the Internal Revenue Service. Each transaction is recorded in a journal, which is called the Book of Original Entry. This allows the accountant to track every transaction chronologically. The increases and decreases for each of these transactions is then transferred to separate accounts. The collection of all accounts is referred to as the ledger of accounts and is therefore called the Book of Final Entry. The process of transferring data as debits and credits from the journals to the ledger accounts is called posting. When this is done, a systematic cross-reference is also recorded so that each account entry can be traced to a journal entry or a journal record of the transaction, and which can then be supported by a source document. This allows auditors to check the accuracy and reliability of the financial reports based on the accounting records of a business. The trial balance is a tool for checking the accuracy of the accounting record. It is based on the fact that total debits and total credits recorded in the ledger of accounts should be equal or balance, hence the term balancing the books. At the end of each accounting period, once a year, The accountant closes the temporary accounts by transferring their balances to permanent accounts using closing entries. The final balances are recorded in the financial reports, a trial balance is performed, and the cycle begins anew. Finally, the authors introduce the subject of financial analysis by showing how the accounting records and reports can be used to judge the financial health of a business. The purpose of Chapter 3 is to give you a conceptual view of the recording and reporting process. The actual bookkeeping is now done by computers. The work was once done by hand and involved much more clerical labor than it takes today. Moving on to Chapter 4, we look at the accounting for a merchandising business. These are commonly called retail or wholesale businesses. A key feature of this type of business involves accounting for inventory. Take note of the learning objectives for the chapter found on page 188. We start with the discussion of the perpetual inventory system. Later, we will introduce alternatives. Our goal is to accurately measure the cost of goods that are being sold. The difference between the revenue from sales of inventory and cost of goods sold is called gross margin or gross profit. After paying taxes, we are left with a net profit. The goal of every business is to make this final number as large as possible. Economists call this activity profit maximization. The balance of the chapter details transactions affecting inventories and sales and their effects on the income statement and the balance sheet reports. In class, we will spend our time working on these transactions, and we will attempt to solve the two chapter discussion question problems that are assigned, the last two in each of Chapter 3 and 4, from the syllabus. Once we've completed these, I can go ahead and enter grades, and you won't have any homework. Let's see how it goes Wednesday night. I'm looking forward greatly to seeing you. Please do not forget to print off a copy of Lesson 2 from the syllabus to bring with you on Wednesday to help us guide our practice. Thank you very much. See you soon.